But the stock that we are going to focus on, the company that we are going to focus on now is KEC International. The company held a conference call recently and it gave out its FY24 order inflow guidance at 20,000 crores. And as of February, the company's order inflow stands at around 14,000 crores. So let's talk about the business outlook, the momentum, and what lies ahead. We have Vimal Kejriwal, Managing Director and CEO at KEC International with us. Mr. Kejriwal, always good to have you on the show. Thanks for joining in. So tell us, as we're entering the last leg of this fiscal, what is the momentum looking like across your business verticals? Because you are a little short of that target of 20,000 that you had put out, but you're confident of achieving it. And if so, tell us where the thrust will come in terms of fresh orders as we're looking at now, the last month of the fiscal year?
So, Surabhi, you're right. We are actually significantly short of order intake target. We are at 20,000, we are at 14. But we have roughly L1s of 7,000 crores, of which more than, I think, 2,000 and odd are with Power Grid, and there are some other domestic players. And then there are a lot of L1s in the civil. We are reasonably confident that most of them, or virtually all of them, should get converted, and we should be able to, achieve our target of 20,000 crores.
I remember Mr. Kejriwal and the guidance. I mean, have things slowed down a little bit in terms of how they're coming along? Good morning, sir. Prashant here. Because I think back in September, we discussed intake of close to 25,000 crores. And then, of course, the last was about 20,000 crores. And now, as you're saying, you're short, but L1s should convert. Most of them should convert, as you say. But is there a general slowdown, a trend that you're seeing at all?
So, morning, Prashant. I think what has happened is, you're right, we were at 22, 23, not 25, but 25 was a very optimistic figure. We had thought we should be able to do it. A few things have changed. I think one is somewhere looking at what's happening in the railways, we have also slowed down a little bit of a focus on railways. Second is private capex has not yet picked up. We had thought we'll get a lot more orders from the private side. So that's something which has a bit slowed down. Thirdly, what has happened is that we also took a stock of our order book and also our cash flows. It's been a little bit of a concern saying what is the debt level and all. So we also started becoming a lot more choosy on the order intake. See, today we have an order book of around 31,000 and 7,000 crores of L1, which takes us to around 38,000. We should be touching a revenue of around 20,000 this year, and maybe let's assume a 15% growth, so 23,000 next year. So we are reasonably okay with our order book for next year's revenue also, and that's why we also started becoming a lot more, I'll say, quality conscious in our order intake. And that has also had a marginal impact on our order intake in L1.
Okay. Mr. Kejriwal, you said slowed down the focus on railways a little bit. Can you explain that?
So railways, what has happened is that we are seeing a significant delay in implementation of many of the infrastructure projects, and also a little bit of cash flow issues for whatever reason. So because of that, I think we have gone a bit slow. And I think what is also seen is that the railway focus right now has been more on, new trains, station rebuilding, etc. And the number of on the infra side, that's new tracks, and all that has been slightly lower. The second piece is the competitive intensity has increased significantly because I think there are lesser tenders in roads. So most of the road EPC players have moved into railways, so which is impacting the margins of the new tender. So I think we have become a bit cautious on the railway side.
Mm-hmm. Okay, all right. Hi, Mr. Kejriwal. Good morning. So we have got a broad outlook in terms of revenue growth, in terms of order inflow, and you're optimistic that you'll get to that number. Let's talk about margins and the working capital days. The last time we chatted, you were telling us that you're expecting margins to gradually improve. I think you're guiding for around 7% for Q4. And gradually it'll move to double digits. So could you tell us by when does it move to double digits? I think 10% we were talking about in FY26. Do you think it can get sooner? And what about working capital days? Give us a broad guidance.
So Nigel, if you look at the numbers, our Q3 margins for 160 basis points, year on year above. We have been talking about 7. I don't think we'll be able to reach 7, maybe a little bit lower than 7. We should be, for the year, should be around 6.5. I think that the major reason is there is some slowdown in terms of our revenue because of the major issue is the supply chain and the Red Sea issue. So we have slowed down on some of our supplies to Europe and to Saudi, etc., because the freight rates have gone up like anything, and we don't need to necessarily do that supply right now. So maybe that part will probably move into Q1 next year. And since those are largely the new orders and they have a higher margin, there may be a marginal impact on the margins for the quarter, but I think that will make up. Next year, we have been talking about, for the year, doing anywhere between 7.5 to 8% with an exit of close to double digit next year end. I think that's the numbers which we are going out on the margins. And as far as working capital is concerned, I think we did show a reduction in Q3, and we are very confident that again in Q4, we'll probably bring down a debt by around 300 or maybe 500 crores is our internal target, and could bring down the debt by 500 crores. So I think we are moving in the right direction on the margin as well as on the debt reduction.
Okay, so just a word on how you plan to reach that level of 7.5%. What will be the kicker? Will it be the mix that changes? Or will it be something else, some of the supply chain issues going away in the international business? And a word on the top line as well, sir, because you're confident that you should end the year with a 20,000 crore rupee order book target. Now, in terms of revenue growth, FY24 looking at 25, what's the top line growth estimation that one can work with when it comes to executing the order book?
So FY25, our top line target is around 23,000. So we are expecting that we will close the year at around 20,000 this year, and there will be another 15% growth for next year. That's the way we look at the top line. As far as the margin improvement is concerned, I think the new orders are coming at a decent margin. And also the major reason for this increase is going to be the closure of the legacy orders. We have been able to close most of the legacy orders. Whatever else are there, maybe this quarter, maybe at the most Q1 next year, we should be out of all the low margin orders. So the major reason is going to be the closure of old orders and execution of new orders.
No, absolutely. So I remember you mentioned this in an interview to us even in December 23, that your newer orders apparently are coming at margins of as high as 10%, if not more. Are these in the T&D segment? Is that the major margin accretive segment for you?
Most of it is in the T&D sector. In fact, if you look at our, we don't give out those many numbers. If you look at our T&D India order intake plus L1 this year, FY24, we should be higher than 6,000 crores. I don't think we have ever seen order intake of 6,000 crores plus in the India T&D. And beyond that, I think we have around 30,000 crores of tender pipeline, either quoted or to be quoted in India. So I think that's one of the major reasons for our confidence on the numbers, across revenue or margins.
The fresh lines to be put up, Mr. Kejriwal, because I remember asking you this on the T&D side, and you said that, at that point, 6 or 7 months back, that it's not new lines, but existing lines to be put together and made good again. But these are new lines. It's a large pipeline.
So Prashant, these are two different issues. One is, there were many plants which are operating at 50-60%, and with the PLF factor and with the power shortages happening, I think most of these plants were pushed. So that's where we got involved in strengthening. But all these are majorly new lines, and I'll say almost 90% or maybe even 100% are for offtake of renewables from Rajasthan and Gujarat. Two states where we are having the maximum work. And I think a little bit happening in the Karnataka side also. But largely, I'll say 90% of our order book is right now from Rajasthan and Gujarat for renewables.
Okay. Got it. And you're saying that tenders and visibility of tenders in that segment is about 30,000 crores, right? Already projects put together, and where there's more so both of that 30,000 crores, which should get awarded out in the next. And any visibility of how much? What would your take be out of this number?
So Prashant, I think we'll have to keep our fingers crossed, because I think the day the elections and all get announced, if some of them get finalized before that, we should have them now. Otherwise, I think we'll have to wait for end of May or something. But most of these are already announced standards, so we are keeping our fingers crossed. And I think I've been watching our channel for the last 2-3 days. We have been seeing, so many of our competitors, vendors are getting orders from Power Grid. So I do see that, there is some fast tracking of release of orders.
Okay, got it. And I mean, once the sort of model code of conduct kicks in, formal government tendering work will stop. And then, of course, restart later. We'll see, but great conversation.
Prashant,
sorry, yes.
Sorry, one more point on this model code of conduct. What we have also seen many times is if the projects are critical, the utilities and all have been going to the election commission and taking approvals to issue orders. So it's not that it stops completely. If it's urgent, they can still get approvals if they want to do it. Okay.
Oh, wonderful. The way it should be. Thank you very much, Mr. Kejriwal. Great conversation, and I think you really provide a sort of very nice sort of view of what's happening in each of these sort of businesses and a bird's eye perspective, which is very useful. Thank you very much for joining us.
Thanks for having me.
With the conversation. All right. So that's KEC International stock, by the way, has jumped up to the day's high. It's up about 4.5% as things stand right now.